Hello, my name is Daniel, and today I'll walk you through my in-depth analysis on flow traders. Can be seen as an update, although I'll go over the entire business model in depth as well, even more depth than last time. But if you want to watch the last video, in the top right, there's an info card. So let's get to it. So let's quickly go over what does flow traders actually do. Flow traders is a liquidity provider, market maker, however you want to call them, which means they provide liquidity. What does that mean? What does providing liquidity in the financial market mean? Well, imagine you want to buy something or sell something. You would have to find someone and figure out the price at which you want to sell it, and the other one wants to buy it if you're selling, or if you're buying, vice versa. Flow traders comes in and provides selling and buy and sell prices, or bid and ask prices for a whole bunch of different products in financial markets. They make money by the small differences in the price that they're buying at or price that they're selling at. They do this with ETPs, exchange traded products. Think of ETFs, exchange traded funds, exchange traded notes, exchange traded commodities, and those mainly are fixed income ETFs, or equity ETFs, or crypto ETPs, or currency or commodity ETPs. These are all assets they trade ETPs for. And what do they then actually do? They provide buy and sell prices and offer volume in the market, which provides liquidity. It allows you to trade, and even if there might not directly be another person to trade with, which is beneficial for you. So how is that divided? Because those are a lot of products, and trading with who. You can divide their activities in three main segments. They're not necessarily officially divided like this, but they have on-screen activities where they are dedicated market maker, and they just provide bid and ask spreads and need to be the most competitive and fast out of everyone. That's the high frequency trading you often hear about, centimeters away from the data centers. And they also have the off-exchange services. This is mostly catered to institutional investors, so think of pension funds or large funds who need to buy or sell large amounts of shares, or not necessarily shares, but ETPs. And they do this through request for quote platforms like Market Access, TradeWeb, or Bloomberg. They communicate with brokers or other institutional market participants like pension funds, and they'll talk to each other, communicate with each other, be it over the phone or through the platform, about what price flow traders can provide for that institution to unload or buy shares or units of an ETP. And this is beneficial for those institutional investors, because they otherwise would never be able to make such large orders. Because imagine buying 1 billion worth of ETPs in certain asset classes might take a while because of the liquidity. And flow traders comes in and tries to speed things up and make it easier for everyone. And they make money by the difference between their hedged risk and what they actually get price-wise. And that's up to flow traders and their complex models to calculate. Then they also provide services as an authorized participant. I'll go over that in the next slide, but that in essence is linking primary and secondary markets for these ETPs, because ETPs are secondary markets, but they can interact, and they're open-ended funds, so more units can be created, the fund can grow or shrink, and you have to link that back to the underlying asset somehow. Flow traders is the person or the institution doing that. So what does that mean? Imagine an equity ETF, so an S&P 500 ETF. It's already on the market in this case, but the ETF holds shares of American companies, and someone wants to buy some ETF units, that will increase the price of the ETF. But the ETF is just a basket of stocks. The price of the ETF should correlate perfectly with the price of what it actually owns. It doesn't provide anything additional. So if the price of the ETFs goes up, or ETF units goes up because someone is buying a lot, for example, then the flow traders will go to the issuer, for example, iShares or Vanguard, and say, okay, we see the price of the ETF is a bit higher than what it's actually worth, because a lot of people have been buying, but the underlying assets haven't seen any interaction, because they've been buying ETF units, not the underlying asset. This is a mismatch, so can you create some more units? Then we'll buy some additional shares, so that by selling more units, they'll bring down the price of the ETF, because more units are in the market. And flow traders buys the underlying and then just gives it to the fund, and they make money by that. And this way, more shares, units in the ETF are created, or vice versa in the selling process. More units can also be destroyed. They can be redeemed. This is how ETFs shrink and grow in size. That's why there's always beautiful round numbers on their side. There's always some discount or premium between the ETF and the underlying, depending on liquidity. But flow traders tries to keep that premium or discount as low as possible, and by making it lower, they make money, and that's in your interest in that regard, because you don't want to pay a premium over in your ETF over the if you would buy the underlying shares. A discount wouldn't be too bad for you, but that is not as good for the ETF provider. So they keep the system running without them. You need a link between the ETF and what the ETF actually holds, and flow traders provides that. So where do they actually operate? They have some offices in Singapore, Hong Kong, Amsterdam, London, New York, but their main offices: New York, London, Amsterdam, and Hong Kong. So they have a global footprint, mostly in Europe. They do operate in the US. With quite some employees as well, but it's not their largest segment. They have a lot of competition in the US as well, from, for example, Fear to Financial. And this is a bit of an outdated map, but they're also opening a new office in Shanghai, if I remember correctly. So what is the underlying business actually doing? Now that we know, what do they do? Okay, how is it going? Because many people that follow this company might have hold this company even have noticed that share price has not been doing too well over the last half year, and here are some reasons for that. ETP value traded is going down. This is not something you want to see, because this is just lower volumes. Maybe your margins increase, but comparison to earlier, the trend doesn't see. It seems like a break in the trend, be it temporarily or not. But it went down. That wasn't expected. And the VIX, or volatility index, is also quite high, but underlying profits actually haven't been too high, but we'll get into that later. This is just the underlying market. Total assets under management for exchange traded products, be it crypto, forex things, or commodities, or bonds, or just normal shares. It's also been declining. And that's something that should concern you if you are interested in flow traders or any of the providers of these ETPs like BlackRock or Invesco, for example. That overall assets under management have been going down, and this isn't just price decreases leading to a decline of assets under management. People also have been selling. That's why the value traded still has remained relatively elevated, but actual assets under management have been declining, and that's not something you want to see, because this is essentially where flow traders derives all their revenue from. Because if less people buy these products or sell them, or are just in these products, then there's less market participants trading, and that's bad for them, because that's in the end their clients. If you also are seeing that B2B velocity, that's how fast things are trading. It's not it's not going too well in comparison to earlier years. So it's to be seen if that will be elevated again, like in 2020. But I wouldn't bet on it. And now going to a bit more recent, shorter term issues, not necessarily in the underlying market, but with flow traders specifically. Flow traders issues loses a lot of money to its employees, not just in fixed salaries, but also in variable salaries. And they recently have been trying to address that, because we see that every time they do well, like in 2020, when they make a lot of money, they also have to spend a lot of additional money on employees, and that's very fun for the employees, but as a shareholder, that's not in your interest. So the profit sharing incentive has been slightly reduced with a huge increase in fixed costs. So I personally don't really see the benefit of this 2.5% decline if they expect a 25% increase in fixed costs over the next year. And that maybe they're just trying to grow, but I don't think they can really capture that much additional market share with additional employees. So personally, I'm relatively skeptical of these cost increases. They did say they expected them to drop slightly in the year after, but I have my doubts. Fixed costs, tend to be sticky, otherwise they wouldn't be fixed. These are technology expenses, and if you hire more people, you cannot just get rid of them in a year. That the flow traders is indicating a decrease in fixed costs, but personally I just expect a higher baseline, maybe not 25%, but 15 to 20% would be my personal expectation for permanent cost increase in fixed costs, and a slight decrease in variable costs, but that is that's almost 2.5% won't make the difference here, especially if you have a 25% increase in fixed costs. That's a lot. They also noted that they added a lot of new listing, or they are active with a lot more listings, and they're really working on crypto, and this in essence was as expected, nothing too exciting here. And this is what the underlying business of theirs has been doing in the first half year. They've also done some venture capital activities, but that's to just grow the entire ETP market essentially. That isn't too big of a part of their business. That's also why it's not that relevant. It's a small part, and it's not necessarily exploding with growth. So don't see the point of really looking at that too much. It's just to support the underlying financial environment, to increase innovation in that sector, and they want some part in that. They have been adding a lot of counterparties, but in essence nothing special here. Nothing that compensates for that 25% cost increase. That this could have been done without that. But yeah, you could say the underlying industry is still growing trend-wise, although it has to be and actually quite fast. Though most of the growth has been in the period after the financial crisis, before COVID, and before COVID. Now it's just stabilizing, so we'll have to see if that continues. So if we go back to ETP value traded, we can see that it correlates fairly well with how the underlying market is doing. So it's to be seen, but I would expect this to continue going up over time, the total assets under management for ETPs, but maybe not at a 21% rate. I think it will drop down to like 3% cumulative aggregate growth rate over the years, but that's to be seen. So now let's start looking more at financials, and let's begin with what the business actually is doing, because margin compression doesn't come out of nowhere. They have been getting increased competition. That's something that has been worrying me last time as well. Though they were more positive that around that time. But their pure arbitrage business is suffering from margin compression because it is a race to the bottom, essentially. They have to increase technology costs to keep speeds up, and increase employee counts to get more programmers, get more engineers, get more mathematicians to adjust all the risk models and get everything right. So they have the best risk models. That's the most important thing here, and that they can properly hedge. And we're seeing that this is getting more expensive. That they're getting hit by inflation essentially, and the industry, out of its nature, it's just an industry with a constantly increasing costs and with super cyclical revenues and income, or counter cyclical, which you should actually say. So the underlying long term, they make a lot of money, they still have decent margins, but we should expect margins to slowly decline. So that's also what I've taken into account in my own valuation model. Here's some illustration of how the fix the volatility index does in regards to flow traders' key performance metrics or key performance indicators. Net trading income. You could see that as the revenue. And EBITDA and net income. That's the three main metrics I looked at here. And don't mind the suspiciously high R squared. If that's a number Google came up with in this model. These are just exponential trend lines. If you want me to do more in-depth analysis, because R squared is a very controversial way of looking at model accuracy or predictability. Or predictability power. So if people want, I can look into that a bit further, how accurate these exponential trend lines would be. But we can see overall there is a trend. Higher fix does mean higher income for flow traders, with a lot of variance. We can see that some years, this data point here, net income was higher than EBITDA in the other year, which is very similar, with an even lower fix actually. This is to the left of this one. So there's a lot of variance in here, a lot of noise, and we don't have that many data points for flow traders, honestly. These are annual numbers. I could extrapolate this to quarterly data, quarterly fix, and then you would have a lot more data points, but there have only been public since 2014, so there's only COVID has happened since then, and we can this current bear market. So honestly, these lines are very indicative, but shouldn't be used as a primary source for all your predictions. Although making predictions with flow traders is essentially impossible, anyways. But I tried anyway, so let's look at the valuation. But first, main assumptions. I couldn't expect that increased fixed expenses keep getting increased, and that there's 20% increase over the next year, and that it won't go down by much the year after, and then slowly grow. An average fix of around 16. I think something in between 14 and 18 would be reasonable. So took 16, could be any number. Who knows what happens? We could also have another year with almost a fix of 30. Then flow traders would be raking in cash, but it could also be a couple of years of 11 or 10 fix. So that has to be seen. This is an assumption. We know that this assumption will certainly be wrong, but there's bound to be volatility in the volatility index. So how volumes and margins behave alongside that is also uncertain. I am assuming margin compression over the next couple of years, mostly due to increased expenses, as they don't really have any other costs. They don't really pay interest, or not a lot. Don't really have any, aside from the technology expenses, they don't really have any factories or anything, and they aren't making a physical product. So they don't really have any other costs aside from employees, technology, and taxes, and some small interest and depreciation charges. I do expect underlying market growth for the HP market, but it's to be seen if that actually materializes like that as well. I expect it to be slow growth over the next couple of years. So let's get to it. Here I have a beautiful spreadsheet with some of the historical numbers for flow traders, with share counts or change in share counts, which you can see that has been beautiful. It's been at zero perfectly, as every share they issue for employee schemes, they have just bought back on the open market. So that's just an additional expense actually, which maybe should be taken from net income. I haven't adjusted for share-based compensation here, which I should do in a more in-depth analysis if people request so. But this is general net income attributable to shareholder indication here. So let's see what we have for the future. I made some predictions. Analysts are more positive on, or expect more from the company than me, but like being a bit conservative in that regard. Because 2020 we already have half the year worth of data, but I expect it to be slightly better than 2021 due to the heightened volatility in the half year, and they don't really have to make that much additional cash in the next half year to come to this number. In the first half year, they're already at 80. So if they make 40 million of worth profit in the next half year, which I don't think is too unrealistic, that should be fine. Then we have a slightly better year than last year. But I expect very heightened fixed expenses, and for them to stay at these levels, because we have seen that employee expense and technology expenses combined, that's what I define as fixed expenses, that those have been growing consistently year over year, and I expect those to continue growing, and it's to be seen how fast it will grow. Here I took a 15%, which, although you can see 25% in employee fixed expenses, the numbers being weighted down a bit by technology expense only going up 5%. So keep that in mind. I do expect a fix of around 16 for the next couple years, with some variance. So maybe 2026 would be a good year, or that could also be another year. But this is just an indication. These numbers could honestly be anything. There's no way in predicting that accurately. So I just took an average of 16 here for the next couple of years, because I think 16 is a decent average fix. And if we have 2 very good years in a row, like 2021 and 2020, or all of Flow Traders' previous history of like 5 years, 6 years of bad numbers in a row, that could also very well happen. Although 2018 was fairly nice net income wise, fix not necessarily, but they did really well that year. It's to be seen how the future lays, but I have my doubts, so I expect significant declines in net profits and EBITDA, and overall just less profits in line with margin compressions. So I indicate here they have had quite decent margins, but something to keep in mind, their margins also go up together with their revenue in good years. So that's a double-edged sword. In bad years, margins go down and revenue goes down. Good years, revenue goes up and margins go up. So if they have a good year, yeah, you will be rewarded as a shareholder, but bad years are just a gamble. So yeah, this is the graph from earlier. Here's the table of the Trendline Formulas. That's also what I slightly based these predictions on, although with an underlying growth in net trading income, or at least relative to what it's currently, and a relative decline in net income. For example, I have a fix of 19 here. That would mean profit at 134 million according to Trendline, but yeah, I've lowered it significantly. That's more than a 30-40% decline. So that's something to keep in mind. It is a relatively conservative analysis in that way, or in my opinion, realistically conservative, but still with those numbers we get to an internal rate of return of around 11%. So that's very decent, given that these are, I think, relatively realistic expectations of a low fix, a lot of margin compression. But flow traders is just so cheap market cap wise. They have gone down more than 50% in market cap over the last half year. Then as I had noted in last video, I didn't want to buy it at 34 because I thought that was trading at slight premium in regard to expectations, and now it's trading at a discount because this company in lower volatility years gets really cheap, and then you get 1 year of exploding earnings, and then everyone thinks they'll earn that money forever. But also vice versa, in bad years they also expect them to do poorly in the next years. So that also you just don't know with this company. They just need 1 good year and then it will make up for 5-6 years of bad results. It's very difficult analyzing it in that regard. But let's get back to the last slide, because valuation wise, I think it's attractive now, but mind the risk. That's what I would say. Know what you own. Really understand what they do. That's what I would say should be your primary concern when investing in flow traders. And to top it all off, let's get back to some comments from last video. John Bryan, I have talked to him a lot in the comments, but this was one of his latest questions, to which I said I would make a more in-depth answer. What was my opinion on the first half 2022 results? Yeah, they were very bad. That's essentially all I can say. There were some good things, like the Shanghai office all expenses are essentially paid for. It's just waiting to open now based on regulatory approval, which they haven't gotten so far. So that's the bad news again. But overall, it was just a very bad report. It just had a lot of more margin compression than people expected, a lot more competition, a lot of added costs. I thought they would remain a bit more disciplined in that regard. Management had been relatively disciplined over the years, but we have seen continuously increasing costs, but now they're actually exploding. So that's very valid concern of the market. If their costs keep going up by 10-15% per year, then that entire valuation I did can just be thrown into the trash can, because then profits will probably half from what I predicted even. So you would get at a rate of return 7% maybe. That's not as attractive anymore for the amount of risk you're taking on with a company like this. For 7%, I can find enough other companies that have way less earnings volatility, way more predictability, less counter-cyclicality, and just provide better overall risk reward. metrics, but yeah, it's to be seen. We never know with them. They do act as a hedge to some extent, although with margin compression and lowered fix correlation, that might be declining as well. How good they are as a hedge. Spazaneva also asked about the webcast earnings call. I had responded to him on that as well, but I'll quickly go over it because essentially what the analysts asked was, fix was high, why wasn't your profit high? Yeah, in essence, we know that fix isn't profit for flow traders necessarily. It is correlated, heavily correlated with profits, but it's a higher fix doesn't always mean higher profits, because the fix is you should know what the fix is. The fix is a volatility index. It measures the implied volatility on the S&P 500 options by CBOE in Chicago, and that's all it is. It's implied volatility, and flow traders has so many other factors in their model that are in their business, like competition, margins, volumes. Those are not included in implied volatility. That's just implied volatility, not spreads and volumes, because that's essentially what's the bread and butter of flow traders. So higher fix doesn't necessarily always translate to higher bid-ask spreads or higher volumes, although a lot of times it does, but not always. And this is one of the times that it didn't to the extent expected. And the fix is US. It's only S&P 500 options, and flow traders actually operates mostly in other countries, so that's also something to keep in mind. There are European and Asian volatility indexes, but indices, but it's just looking at those will not give you an answer how much they're gonna make. If anyone knew, the analyst would, and the analysts have no clue how much money the flow trader is gonna make. Neither do I. I'm not gonna pretend that I have any idea. About what they're gonna make next year. Maybe over the next 10 years we can have some expectations, or 5 years, but their earnings are so volatile and unpredictable. It's bound to happen that they miss some quarters, and then some quarters they do well. And the cost increases. Also, I was also asked about a lot the additional headcount, how that would benefit flow traders. I found their answers on that topic a bit lacking. They expect more innovation, and adding additional fixed expenses, I don't think that will benefit them. But CEO knows the business better than I do, or at least I hope so. Otherwise, that would be very concerning. And if he thinks that they need to add more headcount, I personally think they don't, especially as their costs are already exploding. But moving away from the profit sharing, I do like that move. But the increase in fixed expenses, partially caused by that, is just too big, especially in a year in years like this. So we have to see. Overall, I think flow traders is attractive now, but keep in mind, know what you own. It's not, you might have a high expected earnings yield. It's trading at least on my personal expectations, forward P of around 8.5 or to 9. That could also become 15 or 18. Who knows? But you don't know what they're gonna earn, and nobody knows. Anyone pretending they do don't know the company well enough to see that there's no way in predicting volatility, because that's what you need to do to predict earnings for flow. So in that regard, I wanted to end this video, and if you have any questions, feel free to ask. You can find me on eToro at Tipsino, or just ask me in the comments here. Okay, have a nice day.